So the minimum is 2 for the partnership, the maximum is 20. And anytime or anywhere you have got 2 or more, be it the country, we have the constitution, we have the church manuals for their churches, we have the schools, code of conduct and all that. Anywhere there is more than one person, there must be a guiding document on how those people are going to relate with each other. So for the partnership, we have the partnership agreement. And the partnership agreement stipulates on how the business will be managed, how the partners are going to relate with the business, and what the partners are going to bring to the business, what the partners will be entitled from the business. All that will be captured here in the partnership agreement, also known as the partnership deed. So in the partnership deed, we are going to have one amount of capital from each partner, amount of capital to be contributed by each partner. We are going to agree and record it in the partnership agreement. Number 2, it is about the share of profit or loss. The share of profit or loss. How are we going to share our profits and our losses? We need also to agree on that. The other thing is about what would be the interest on capital, if there will be any. The partners have contributed their capital. At the end of the financial year, these partners, are they entitled to interest on capital? We need to capture that. Just a minute. Some partners can say, now that we have sacrificed our capital, by the end of the year, then we should pay ourselves an interest of, for example, 10% on the capital each and every partner contributed. If it is there, it must be in the partnership agreement. Also, what we call the interest on drawings. If the partners will be required or will be allowed to withdraw some resources for their own personal use, and then they pay back later, then if we were to charge them interest, it is an interest of what percentage? The other thing is about how to admit new partners in future. If we were to admit new partners, what is the procedure? What will those new partners have to comply so that they are admitted? How to retire? How to retire or expel? If the partner wants to leave the partnership, what will be entitled to that particular partner who is retiring? Or if it is a misconduct, we are expelling the partner, what or how are we going to expel that partner? The other thing that will be contained is something to do with salary to active partners. Those partners who are very active in running the day-to-day activities of the business, are they entitled to salaries? And if they are, of how much? It must be in the partnership agreement. Others, they include things like how to inspect the books of accounts, the duties of the partners, the name of the partnership, the location of the partnership. All those will be captured under the partnership agreement. Now, 90% of how we prepare the statements of a financial position and the income statement of a partnership is going to be similar to that of a sole proprietorship. The only difference being in partnership, we need to go ahead and do two extra things that we don't do for the sole trader. For the sole trader, We used to prepare the income statement down the sales, less cost of sales, with less expenses, we get the net profit. We stop there. But now for the partnership, we need to go an extra mile and show how that profit will be distributed among the partners. For the sole trader, once we arrive at the net profit, the entire net profit belongs to the sole trader because the business is owned by only one person. This one is owned by 2 or more people. These 2 or more people, how are they going to share that particular profit or loss? So we are going to prepare what we call the partners appropriation account. At the foot of the income statement, we go ahead and prepare the appropriation, which will show how the profit will be shared. Once we have done the appropriation, the other document that is in the partnership account, which is not in the sole trader, is the partner's current account, which will show what the partners are supposed to gain, what the partners are supposed to pay back to the business. What they are going to gain, we credit the account. What they are supposed to pay back to the partnership, we debit their current account. So, for the appropriation account, is very simple. It's just an extension of the income statement. You come here and you say net profit for the year. This is the net profit that we have actually be able to generate that year. To that net profit, you add interest on drawings. This is an income. Remember, when you charge the partners interest on the drawings that they made, that is like income to the business, which is now the partnership business. Right? We add to this net profit. So the interest on drawings from partner A, partner B, you add it to the net profit for the year, you will get now an amount that we are going to distribute to the partners. Interest on drawings, it is an income to the partnership. So we add it to the net profit the business was able to generate through buying and selling of goods. So that we have this amount here, which now we are going to distribute among the partners as follows. The order is that after all, the first priority is normally interest on capital. What partner A will get as interest on capital contributed, what partner B will get, you add that, you are going to less from that amount. You come here and you also do less the salary to partners. Salary to partners is not an expense. It will not be in the income statement. It will come under the appropriation. If partner A is entitled to salary, you put there. Partner B is entitled to salary, you put there. You sum the two, you get there. The other thing that we normally less, which is sometimes there, but in most cases you find that it's not given, it is the loan repayment to partners. Loan repayment to partners. Loan repayment to partners. If we had borrowed money from the partners to boost the business, and we are paying them back, what A will get, what B will get, it will still be paid from this amount. Like that. Now you find that this was the amount available. We have paid the interest on capital, we have paid the salaries to the partners, we have paid the loan repayment to the partners. Then, if you let now this and this and this from this amount, we shall get now the amount to be shared. The amount to be shared among the partners. In the profit and loss sharing ratio, what A will get, put there. What B will get, you put there, and then the total amount will transfer there. You find that this now minus this will give you a zero balance or nil or zero. Nothing will remain. The partners, they normally share everything. And you are done. That is how the appropriation is done. Maybe if I take you back a bit, you start with the profit of the year. If there is interest on drawings, add it there. You will get now the amount which will be available to pay interest on capital, salaries to the partners, loan repayments to the partners, and then after paying these three, what remains now is what they share in the profit and loss sharing ratio as they agreed. If they agreed to share the profit equally, this amount will be shared half-half. If they agreed to share in the ratio of 1:2, this one will share 1/3, this 2/3. So that is how we are going to do it. That is the appropriation account, the partners appropriation account. Good enough. I want to show you how to do the current account. Then we do two examples on the same as we move ahead now to the final accounts. So these are the partners. The partners current account. We have the debit and credit, so we come here and say that this is the credit side of partner A. This is the debit side of partner A. The debit side of partner B, the credit side of partner B. Yes, it is being recorded. So the partner's current account. So we combine these two accounts together. Instead of having for A separate and for B separate, you combine them together. So the current account, they simply show what the business or the partners, these are the partners' current accounts. On the credit side, it is what the partners are supposed to gain or to get from the partnership. What they will gain or get from the partnership. So the partnership will pay them that amount with credit. On the debit, it is what the partners are supposed to bring back. They owe what they owe the partnership. What they owe the partnership, we debit. What they are supposed to receive from the partnership, we credit. That is the rule. So, under normal circumstances, current accounts are supposed to have a credit balance. So if you are given the balances for the current accounts and they are not indicated as debit, you should always know that they are credit balances. So we start with the balance brought down like that. What are they going to get from the partnership? One, it is the interest on capital. That is a gain to the partners. You credit. What else are they going to get? The salary. If the partners are getting the salaries, so they are gaining from the partnership, you credit. The other thing is the share of profit. That is a gain, you credit. Those four are normally credited, and also the loan is paid. They are paid back the loan. They are gaining that money back from the partnership. Those we credit. So on the debit, we have said it is what the partners owe the partnership. So they are supposed to pay the partnership. Sometimes the balance brought down can be here, but very rare. If it is a debit balance and which the question must specifically tell you it is a debit balance, put it there. Then what they owe the partnership, number one, is the drawings. Drawings is the resources they took from the business, so they need to bring back. Then we have the interest on drawings. We also debit because they are supposed to pay the partnership. Lastly, it is what we call the share of losses. If the business made a loss and not a profit, if they are sharing the loss, it comes here. But if they are sharing the profit goes there. Lastly, now you calculate the balance carried down. The balance carried down, you determine if it is A, you add the total of A on this side, you minus the total of A on this side, you get that balance, so that the totals for A can be equal on each side. For B, you do the same. You add for this side, you get a figure there. You minus the value of B that is on the debit side, you get that. So that the totals for B can also be the same. Very rare occasions, the balance carried down can be here. When they are here, this is a debit balance. When it is here, this is a credit balance. So the purpose of preparing this is for us to be able to get these closing balances, which we normally carry to the statement of financial position. When it is a credit balance, we shall add to capital. Credit balances, this figure and this figure, we shall add it to the capital contributed. If it is a debit balance, this one, we shall deduct from capital they contributed. So the purpose of the current account is to determine these closing balances and whether they are debit or credit. Credit balances, we shall add that to the capital contributed by the partners. Debit balances, we are going to deduct from the capital contributed from the partners. And that is all. That is all about that. So on that note, I want us to do one or two questions. Look at the documents I've just shared with you. Partners appropriation and current accounts. That is the document I want you to open.
This meeting is being recorded.
So I want us to do question 1. I'll do question 1 and 3. Then you will do 2. So question 1 says that Abu and Boro are partners in business. Their partnership deed provides for, it says that the partners should share the profits and losses equally. Boro to receive an annual salary of 48,000, interest on capital to be allowed at 10% per annum, and then you are given the information on what happened in the year ended that 1st of December 2015. Capital, Abu contributed 240,000, Boro contributed 200,000. Net profit for the year was 180,000. Appropriation account is what is required here. So I will just prepare the appropriation account and use the information to do the current account, even if we are not told to prepare that. So let us go to the board. So this is Abu and Boro partnership. Profit and loss, appropriation account will be for the year ended 31st of December 2015.
Hello, Mwalimu.
Yes.
Yeah, is it a must that you write profit and loss, or you can just say appropriation account?
Even appropriation account is okay, eh? Because at the end of the day, appropriation is appropriating either profit and loss. Eh? No problem. Then we fix the figures using the format that I showed you. We start with the net profit for the year. Which we are told was 180,000. Eh? If you read the question, there is nowhere we are told about interest on drawings. Interest on drawings, if it is there, don't forget to add it to the net profit of the year. But this question, there is no drawings, there is no interest on drawings, so there is nothing to add to the net profit. So we shall come here and say less interest on capital. What Abu should get, yeah, and what Boro should get. Interest on capital is charged at 10%. The capital for Abu is 40,000. 10% will give us 24,000. For Boro, it will be 10% times 200,000. That is the capital he contributed, which will get 20,000. So the 2 is 44,000. And remember, it is less. You put it into bracket when you are subtracting. What else? Boro to receive an annual salary of 48,000. From this amount, again, we shall pay the salary to Boro, which we are told is 48,000. The point to remember there, for the salary, sometimes the question can trick you. Eh? they give you monthly salary. If it is monthly salary, make sure you convert it into annual. Make sure the salary is annual. Do we have anything else that they will pay from that before they share the profit? Nothing. So, what is the figure there? 180,000 minus the 2. $180,000 minus 44,000 minus 8,000. That becomes 88,000. That is 88,000, which is the amount to be shared now. As per the profit and loss sharing ratio. And in this question, we are told profit and losses to be shared equally. What Abu will get and borrow will be equal, so it will get half-half. Which will be 44,000 for Abu, 44,000 for borrow, so the total is 88,000, which when we deduct will give us 0 balance. That is the appropriation account. That is the appropriation account. If we are to do the current account using this, if you are to do the partners, current account, this is Abu borrow on the credit. Debit, Abu borrow. Whatever we have here is what we transfer here. Apart from maybe drawings or the current account balance if you are given. But in this question, you are not given the current account balances. If we were given, we could have started with them. So you need to ask yourself from these figures, what or which figures are the partners supposed to bring to the partnership with debit, and which figures are going to the partnership or the partnership or the partners are gaining. So you agree with me that interest on capital, it is a gain to the partners, whereby Abu is to receive 24,000, borrow was to receive 20,000. You record it as that. What about salary to borrow? It is a gain to borrow. Abu is not getting a salary, but borrow is getting 48,000. That one. What about the amount of to be shared? This is share of profit. Share of profit, Abu is getting 44,000. The other one is getting 44,000. We don't have anything to debit because we don't have drawings, we don't have interest on the drawings, we don't have a loss here. So you simply balance this one. You simply balance. How do you balance? You do partner by partner. So I'll come here and add 24 plus this one would be 68,000. So the balance for Abu is 68,000. So that this one can also be 68,000. I'm done with Abu. I go to borrow, whereby you have 20 plus 48 plus 44. You get 112. So the balance carried down is 112,000. Here we have 112,000. That is the end of the current account. So if this one, remember, is a credit balance. This one now, this figures we could have added to the capital in the statement of financial position if we want to prepare. Good. Good. Let us do question number 3 together again. Question 2 you will do at your own free time. I want to do 3. Tom and Jerry have been in partnership business since January 2021 with a capital contribution of 60 and 40,000 respectively. The partnership agreement states that interest on capital is 2.5%, profits to be shared in the ratio 2:1, maintain capital accounts, meaning that we are not adding more capital, charge 3% interest on drawings, then you are given the drawings for the year, you are given the net profit for the year, you are told you do a profit and loss appropriation account and the partner's current account, and that is all. This is how we also do it, very fast and simple. Tom and Jerry. Profit and loss. Account for the year ended. The 1st of December. So the year must be ending on 1st of December if they started operating from 1st January. Net profit for the year. $323,500. In this question, we have interest on drawings, so we add it. What Tom will pay, what Jerry will pay. We are told that charge 3% interest on drawings, so this one will be 3% times the drawing amount for Tom. Tom had made a drawings of 150,000, money taken from the business for personal use. The other person is 100,000, so 3% times the drawings amount for Jerry. We get for 500 for Tom. $3,000 for Jerry. Total, it is 7,500. If you add to the share of profits, net profit of the year, it is at 1,000. That is the amount that is available to pay the interest on capital, to pay any salary to the partners, and also to be shared in the profit and loss sharing ratios. So, what do we have here? We have interest on capital, so we shall say here less interest on capital. Tom, Jerry, interest on capital is 2.5%, 2.5 times the capital for each. The capital contributed by Tom. Remember, we are told that Tom and Jerry have been in a partnership business since January 2021 with a capital contribution of 60,000 for Tom, 40,000 for Jerry. So if you do 2.5% of those capital contributed amounts, $1,500 for Tom, $1,000 for Jerry. You combine them, they become 2,500 to be paid from that. You don't have salary to any partner. So that is the only amount to be deducted from 331,000. $328,500. That is the amount to be shared. Then now you less share of profits. What Tom will get, what Jerry will get. Remember here we are told that they were to share the profit and losses in the ratio 2:1. If it is the ratio 2:1, then it simply means that you add 2 plus 1 will be 3. You add the ratios. Then the proportion of Tom will be 2 because his ratio is 2. It is 2 over the sum of the ratios, which is 3, times that amount, 328,500. For Jerry, the ratio is 1 over the sum, 1 over 3 times 328,500. Like that. To 19,000. Add this one with total 328,500, which when you deduct from there, nothing will remain 0. Here. That is the appropriation section. Then now you construct the partners current account. This is Tom and Jerry on the credits. Tom and Jerry on the debits. We don't have the current account balance provided here, and if it is provided, we could have factored it before we do anything. But now, the figures we have in the appropriation, we transfer them to the current account. So one is the interest on drawings. That means that is what to be credited. Here we have interest on capital. 1,500, 1,000. Share of profits. Which is here 219,000, 109,500. What do we debit? One is the drawings amount. The drawings amount, the amount that they will due. Tom is 150,000, that should be paid back, and 100,000 for Jerry. Together with these drawings, they also need to pay interest on drawings, which we have calculated here. For 500 for Tom, 3,000 for Jerry. Then you balance them. You balance them. So let me start with Jerry. This is 1,000 plus this one is going to be 110,500. This side should also have 110,500. The missing figure there is the balance current down. So if I add this and the minus from this, the balance is 7,500. Get it. For Tom, if I add to 2,500, minus this, you get the balance is 66,000. That is the end of your current account. These again are credit balances which we are supposed to utilize when we do the statement of financial position. We add them to capital when they are credit balances. So that is all about the appropriation and the current account. Now, I want us to do one full question whereby we are supposed to do an income statement. Instead of being provided with this net profit, we do an income statement to arrive at this net profit. We appropriate it, we prepare the current account, then also we prepare the statement of financial position so that I can illustrate what I mean by saying that these balances in the current accounts should be added to capital. So there's this question on Julia, Fred, and Carol, who are in partnership. We are given the information, and then we are told you do the partners' income statement. Remember, for the partners, if you are told the income statement, you must incorporate the appropriation. So you'll get that net profit and appropriate it until you get that zero at the end. Then, before you do the partner statement of financial position, you must do the current account, whether you are told or not. You must update. Remember, we are told the current accounts here, but these current accounts are as per the beginning of the year. Once the business has done business for another 1 year, these current account balances are supposed to be updated. You credit them, you add what they have earned in that year, you less what they are supposed to bring to the business by debiting, then you get the closing balances which you take to capital when preparing this. So we have already done the statement of financial position for a sole trader. 90 or 95% is similar. It is only the appropriation and current account that we have not covered previously. So in this question, we are given the trial balance, which is here. We are given the additional information, which we said we treat them as end-year adjustments. But part of this, it is the partnership agreement. The partnership agreement, you only use it when you are doing appropriation. If it is touching on the partnership agreement, then you only use it in the appropriation section only. So allow me to do the question on the board. So this is about three partners by the names Julia, Phil, and Carl. So we have the first one is the income statement. For the year ended, we are told that first December 2017. For the year ended, that 1st of December 2017. As usual, get to the three columns there. We are given the sales. The sales amounted to 3,200,000. Once you have captured sales, whenever you are doing the income statement, whether it is for the sole trader or for the partnership or for the company, confirm whether there is sales returns or return inwards. Out of the goods that were sold, do we have goods that were returned back? If we have, we deduct because those goods are not sales. They are already back to stock. So if it is given there, there's return inwards. The return inwards is of what? 120,000. That one will give you 3,080,000. 3,080,000, what we refer as the net sales. From the net sales, we normally less cost of sales, which we underline because it is not a figure we pick, it is a figure we compute. You underline. How do we arrive at it? Opening inventory. Mostly given in the trial balance, and it is captured there as item number 2, stock on 1st of January, 189,000. It goes to the middle column. To add to that, we normally add purchases. Purchases, if it requires adjustments, we put it in the first column. When we have purchases returns carried inwards, we adjust it in the first column. 1,711,000. What do we add to purchases? Carried inwards. The cost of transporting purchases is the carried inwards. It is a cost that was specifically incurred as a result of buying those goods. So it increases the cost of the purchases. We add it. In this case, it is 48,000. Then we less if there is what we call purchases returns, which we have. The purchases returns amounted to 242,000. This one we are resting. Any figure you are subtracting, put it into brackets. So let us calculate this so that we can get the net purchases, the actual value of goods that we acquired. Plus 48,000 minus 242,000. You will get 1 million, which I can transfer it now here. 1,517,000 net purchases. That is the value of goods that we added in the course of the year. If you add this and this, opening inventory plus the net purchases will give you cost of goods. available for sale. Cost of goods available for sale. 1,706,000. That is the cost of goods available for sale. From the cost of goods available for sale, we minus closing inventory. Which is normally captured under the additional information. If you read your additional information part 1, inventory as at that 1st December, that is the end of the year, the close of the year was 206,000. Minus that, we shall get the cost of sales, which now you are calculating here. You take it to the last column where it says 1,500,000. In the bracket because we are lessing that. It was less, so we subtract by putting it into brackets. Sales minus cost of sales will give us the gross profit for the year. You get 1,580,000. That is the gross profit for that year. The procedure is, once you have the gross profit, confirm whether you have got other incomes. Gross profit is simply income that was generated through buying goods and selling them at a higher price. But do we have other sources of income not related to buying and selling of goods? That's confirmed from the question. We have things like discount received, rent received, commission received, interest received, all those. We add them here if we have them. So I can see there is rent received, but connect that one with the Roman 2 of the additional information, which says that rent receivable outstanding was 20,000, meaning that we have not received 20,000, and from the trial balance, what we have received is 200,000. If we have received 200,000 and we have an outstanding of 20,000, we said accruals we add. So we add so that we can get the total rent receivable. Add rent receivable, which is actually 200 plus 20,000. It will be 220,000. 20,000. You add the accrued amount. Do we have anything else? We don't have any other income, so we can simply add this. 1,800,000. We shall refer to it as total income. Total income for that year was that amount. Then to that amount, now we shall less expenses, which we also underline because it is quite a number of items. I want to go to the additional information so that we don't forget anything. Number 3, provide depreciation on furniture and fittings, 10% using reducing balance, and motor vehicle at 20% on cost. I hope you have not forgotten how to do depreciation using either of the methods. Depreciation is an expense. Furniture and fittings, we are told we do 10%. When it is reducing balance, we say you use net book value. Net book value, you get it by what? Take the cost of the furniture and fittings, 1,650,000, minus the depreciation that is given there. Provision for depreciation for This is captured as 650,000. Provision for depreciation is given there as 650,000. When it is on reducing balance, always deduct the depreciation provided so that you can get the net book value. Net book value is what you multiply by the rate of depreciation. That is as per reducing balance method. So this one will be 1 million, 1650 minus 650 is 1 million times 10%. That will give us a figure of 100,000. For the motor vehicle, we are told the rate of depreciation for motor vehicle is 20%, but this one now we are told is on cost. So we don't deduct depreciation first. We just use motor vehicle cost, that is 750. Direct. We get it is 750,000. The other two, number 4 and 5, that is the partnership agreement. Partnership agreement information, we use it when we get to the appropriation and the current accounts. So we go ahead and list the other expenses now from the trial balance. We have salaries and wages. $5,000. Electricity and water. $6,000. Telephone expenses. $12,000. General expenses. $30,000. Since we have exhausted, the others are not expenses. Remember, we are only supposed to deal with expenses. Assets, capital, and liabilities, they should not appear here. So, what is the total expenses? 1,203,000. If we do that, we shall now get the net profit. Which is 597,000. And the moment you arrive at the net profit, that is where appropriation now starts. You continue. For the sole trader, we used to stop there. But now this is like our net profit for the year. You add interest on drawings, you less interest on capital, salaries, and all that, so that you can get, or you arrive at the zero at the end. So we are now at the appropriation. We continue with that now. If you read at the question, look at the question, especially on that part whereby we are given the partnership agreement. The partnership agreement that we are given here are only two statements. Partners' profit and loss will be shared in this ratio. Julia earns a salary of this, while Faith earns a salary of this. We are not given any information to do with the interest on drawings. We have not been given anything to do with what? Interest on capital. So anything not given, you assume it never existed in the agreement. So you only work with what they have agreed. So they have only agreed to pay what? There is no interest on the drawing, so we are not going to add anything. So we are going to say less salary. The first person who is earning the salary is Julia. The second person is Faith. And on that case, what goes to Julia as salary is 63,000.
Marimu,
Yes.
when doing this other part of appropriation, are we not
Yes.
going to have a different heading on this, or are we still going to just continue with that calculation?
Continue. It is a continuation. There is no need of doing another one because it is one and the same building. Appropriate to that. So this one is 63,000. This one, was it take a 4,000? Which comes to 147,000. Then, because that is the only item that they will pay from this before they share, you will find that the amount to be shared is this minus this, which is 450,000. Then now we shall less a share of profit. But if you start even a new appropriation account, nobody will penalize you. It is the same thing, but instead of rubbing or starting something new, continue here. Somebody will know that once you have reached here, you are now dealing with the appropriation. But if you start afresh or you start a new statement for the appropriation, well and good. Share of profit, here we have got 3 people. Part of it will go to Julia, part of it will go to Faith, part of it will go to Carl. We are given the profit and loss sharing ratio. We are told it is 3:5:2. So the ratio, look here, it is 3:5:2. If you add this up, it will give you 10. So this is for Julia, this is for Faith, this is for Carl. So Julia will get 3/10 times that amount. Carol will get, her ratio is 5/10 times 450,000. Sorry, and then Carol 2/10 times 450,000. Then you compute those figures. You compute those figures, you realize that this one will get 135,000. Faith will get 225. Then Carol will get the remaining balance, which is 90,000. Part of this is going to give you 50,000, which will give you zero balance. That is now the income statement together with the appropriation. Together with the appropriation, that is how it will look like. This section of the appropriation, whatever we have here in the appropriation, together with the drawings, if it is there, and the current account balances, if they are there, we need to use them to update our current accounts. Let me do it on this end. The current accounts. Julia, Phil, and Carol. So let us go now to the statement. To the question. There's somewhere you are given the current accounts. Those are the balances when the year was started. The year has come to an end and we have adjustments to make on those current account balances. So we start by with them as balance broke down. For Julia, it was 15,000. For Faith, 36,000. Sorry, it is a bit squeezed, and the other person is 48,000. You just copy from the question. And as I said, if the balances you have not been told that they are debit, make sure that they are on the credit, unless you are told that the balance for a particular partner was having a debit balance. That is when you record it on the debit for that partner. But if the question is silent as it is, all those balances are considered to be credit balances. So what are we going to capture here now? From what we have on the appropriation section, we have got salary to two partners, Julia 63,000, paid 84,000. Carol is not entitled to any salary. Share of profit. The share of profit, 135,000 for Julia, 225,000 for Faith, 90,000 for Carol. The share of profit, 135,000, 225, and 90,000. Do we have drawings? We didn't. So therefore, we can simply balance. Let us total these ones. For Julia, it's 15,000 plus 63,000 plus 135,000. We get 213,000. So the balance carried down for Julia is 213. So that the total here can be 213,000. We go to Faith. The total on the credit $345. So the balance is 345,000. Here it is 345,000. We finish with Carol. 138,000. The balance therefore is 138,000. That is the end of that current account. Those current accounts, they are now updated. We started with these balances. After that year, these are now the closing current account balances, and this is what now we use in the statement of financial position. So we can do it very fast. Now that one has no issue. This is Julia, Faith, and Carol partnership. Statement of financial position. As at 31st of December 2017. As at that 1st of December 2017. So as we know, we normally start with the fixed assets. We capture their costs, accumulated depreciation, net book value. So what are the fixed assets in this business? One, it is the motor vehicle. Sorry. We have got premises somewhere, which we know is simply land and buildings. Land and buildings combined, they make premises. What is their cost? 4,850,000. If you read through the question, there's nowhere we are told about their depreciation, no depreciation. The net book value is the value at the end of the year after undergoing depreciation. Because they are not depreciating, their net book value, the value at the end of the year is the same as what? The cost. We have not undergone any depreciation. That's why we have not been provided. The other fixed asset is the motor vehicles. The motor vehicles, their cost were 3,750,000. Remember here we are doing accumulated depreciation, accumulated, the total depreciation to date. So there is depreciation that is in the income statement here. There is another depreciation that is provided in the balances. You add the two. You add the two to get the accumulated. This one here, it is for this year only. This depreciation that we got here for motor vehicle, 20% of this, which was 750,000, it is for this year only. But before the start of this year, motor vehicle had also lost another 750. So total is 1,500,000. You add the two. In the income statement, you only use what you have calculated. In the statement of financial position, the accumulated, you add both of them. $2,050,000. Furnitures and fittings is another fixed asset, whose cost was 1,650,000. The accumulated depreciation, you add the two. In the income statement here, it was 100,000. In the balances provided in the trial balance, provision for depreciation, furniture and fittings is 650 plus 100,000 will be 750,000. We get 900,000. We don't need the total for accumulated depreciation. We don't need the total for cost. We only need the total for net book values. $8 million. The fixed assets we have at the end of the year, they have a value of $8 million. Then we capture the current assets. We have the closing inventory. By the end of the year, additional information number one, closing inventory was 206,000. There is also outstanding rent receivable. After outstanding rent income. An accrued income is an asset, is a current asset. It is money that is ours but not yet received. Additional information number two, 20,000. Then we have accounts receivable or debtors. The accounts receivables or debtors. $1,480,000, $1,480,000. There is also cash at the bank. The cash at the bank is $920,000. Then we have cash in hand, 124. That is the list of the current assets. That is the list of the current assets that we have. And do a total. $2,750,000. Add with this, we can get the total assets. The total assets, $10,750,000. $10,750,000 is our total assets, both current and fixed assets. How are they financed? One is capital, and the capital, remember, it is a contribution because it is partnership. What Julia contributed, what Faith contributed, what Carol contributed. The contribution here for capital is $2,565,000. That is Julia. Faith is $2,800,000. Carol is $3 million. What of capital? It is $8,365,000. That is the point whereby you come now and capture the current account balances. What is the balance of Julia, Faith, and Carol? And we use what we have here. We use what we have in the current accounts. The current accounts. The figures that we shall use is these figures. So 213,000 for Julia, 345 for Faith, 138,000 for so 213,000 for Julia, 345,000 for Faith, 138,000 for Carol. The total current account $696,000. Then we finish by capturing the current. Because we don't have any bank loan, because we don't have any long-term liability, the last item will be the current liabilities. In this case, we have the account payable.
Excuse me.
Yes.
Yeah,
Yes.
after motor vehicles, there is a current account. What were they for?
Current account. Current account, I told you when we were preparing the current account that we have on the book.
Mhm.
We have the current account on the board. This one.
Yes. And these ones that are provided here, what after the capital account, then on top there is current account. Where do you use it? 15,000 at 648.
They are here. If they are not,
Okay.
when we are current accounts, we started by them, balance brought it down.
Oh, I get it. I get it.
So we used them to update so that we can get now the closing balances. This
The
are-
actual, okay, the closing. Okay.
yes.
Fine.
So we
Noted.
have, don't use them the way they are. Bring them in the current account so that we can add what the partners benefited in that year so that we can get the closing balances. These closing balances now is what we use in the statement of financial position.
Okay.
So the current accounts here we have, sorry, is not in line. The only thing we have here is the accounts payable. The accounts payable, which is of an amount of what? 1689,000. So that we can get the figure for the total capital and liabilities.
Sit here. Mhm. Can't pay up. Can't, so can't pay up.
And 750,000. And 750,000.
Mm.
Any question?
Huh?
Anybody with a question? So accounting is all about entries. Any correct entry you make, you get marks. We don't mark at the final answer. We mark the steps. As you move along, you go accumulating the marks. So just understand the format, just understand the procedure, and you are sorted. So I will stop there unless you have a question. So let us stop there and have a very blessed day. Have a very blessed weekend. We meet again next week. But tomorrow is Sunday. Yes, tomorrow you will be having Mr. Ezra. He will take you through the ratio analysis. So at our usual time around the 4 p.m., he will communicate. We will do with him some ratios. Bye-bye. Enjoy your day.
Thank you, Mwalimu.
Thank you.
Thank you.